Hi, good evening. It's March 30th, 2020, and this is another episode of the Honeymoon Traders. And I got my wife here today.
Good
Hi, babe.
evening.
Yep. Disclaimer: we know nothing. This is for entertainment purposes only, and trade at your own risk. And do
Wow,
your.
you really abridged that since the last
Yeah,
time.
that was way too long.
hmm
So, anyway, we want to show some trades that we're thinking about, or we were thinking about today. Uh, My wife has been interested in. Why can't I get my chart up? All right, this is killing me.
We were looking at the put and call pairs options trading today.
Yes.
And I guess, the risks associated with options, we all may be familiar. They expire. So that stinks. You're just betting on the direction and you get a certain amount of time to achieve profitability, or you run out of time and they keep all your money.
Yeah, but we, yeah, I've always never really done good in long term options. Sometimes I did, but not all the time. I mean, um, first of all, they cost a lot of money. The more forward you look into the future, even the out of money ones are spendy sometimes. So anyway, and they will lose value. So we're just day trading, and just to show you that you don't really have to spend a lot of money to make money or put that much money on the line, especially like on a day like today. It doesn't
I don't
work.
think you should use the word put out of context of put and call, because it kind of sounds a little
All right.
confusing.
So yeah, where you place your money, but on a day like today, with the trend line intact all day, and it rose, and it wasn't too fluctuating. That means it didn't go down very far from where it opened, and it didn't go up very far from where it opened, but it gradually did go higher. So the options that you liked, were the pairs trading, where you're doing a buying a put and buying a call. In this case, there's many ways
So
of
the one that I'm most familiar with is at a certain price point, you buy a call that expires at the end of the day, and you buy a put at the same price that expires at the end of the day. One of them is bound to be more valuable by the end of the day. A stock can't do nothing.
Yes, well, it can go sideways, and then both
Right.
your options go out of them,
Yes.
lose money all day long. But
Yes.
you know, um, we're betting that it's going to go extreme one way or the other.
Yes. So
So
that would be, yeah. So
so
you're taking two-thirds. You can go up, you can go down. You can't do sideways.
yeah,
Consolidation
and
will
so you
kill
could,
you.
right. So and you could, and I usually don't buy options when at the strike price that they're at. Usually they're more expensive, and uh, um, you just pay less, and the more out of the money you look into it. So like especially like today. So, and I usually go whatever it opens up at. This one opened up today at 256, 255 level. Let's just say as soon as it opened, it went up and then came back down. So let's just say between 9:30 and 9:45, you decided to buy a put and a call. And I usually do five strike prices forward and five strike prices back. Meaning, if we were trading around 250 right here at the beginning of the day, I'd buy at the 255 level. I'd go for a 250 call and a 250 put and a 260 call. You understand?
Yes.
And
hmm
then so we have them here already. So we have a 250 put at 9:30. At 9:30 would be, you would have bought it right here around $1. So one option you would have paid $1 for,
hmm
times 100. It would cost you $100.
hmm
And so your own, so these are naked calls and puts. So your $1, that's as far as you can lose from that is your $1 that you paid for it. You can't lose any more than that. So and because the market kept going up all day long, this eventually lost all its value by the end of the day because it
Mhm.
expires today. So your $100 would have went down to
So at any point,
1 cent,
really,
or
you could
one
have
dollar. Yeah.
liquidated this at 10 a.m., 11 a.m., and only lost 30 cents of the dollar. Um, but eventually, if you had left it to its expiration, it would have been worthless. You would have lost all $100.
All $100, correct? Yeah, and like I said, at any point at a time in the day, you could be like, "Oh, I'm totally wrong in this direction.
Mm-hmm.
I'll just get out for
Sure.
my 20 cents, 50 cents, whatever." It doesn't. But if you left it alone all day long, for sure, if it was going against you, it was going to go down to 1 cent. 1 cent would have been the bid price by the end of the day, and so you would have lost your $100. Now
Would you have lost $99
you
if
would have
it?
lost $99. Well,
Okay.
100 because it cost what, 60 cents, 65
Oh,
cents for
correct.
the
Okay. Yeah, the trade's
contract
not free. Okay.
twice.
Yes.
So that's a buck
Mm-hmm.
25 cents or
Mm-hmm.
something, somewhere around there. So on the other side, you could have done the call, the
Right. So the
260
call,
call,
meaning the bet that the market will go up,
right? A
and with the
naked call,
same 1 day expiration.
same 1 day expiration, and going back to 9:30 in the morning. Did I go too far? Yes.
Are you in the right day? Hold on. I don't know. You mean you're at 3 p.m. Which day are you at?
Okay.
Is that today? You have to go back to 9 a.m. You're at 2 in the afternoon. There we go.
All right. Yeah. So today at 9:30, between 9:30 and 9:45, you would also paid.
More like $1.50, but no, close to
Right. Well,
$1.25-ish.
this is nine.
Oh, okay.
Between
I see
nine
it.
thirty and nine
I see. It's
forty-five.
at $1. It's
It's
just
at a
yeah.
dollar. You would
Okay.
also paid $1 for this.
So $100
$100
for
on
a
the put.
260. Yeah.
For
No, a call
260.
up. It's a call.
Right. For $100 for a put and
Yes.
$100 for a call. Correct.
Correct.
It would
All
have
right.
cost you $200 for this pairs trade.
So the
Not
put
not
is the
together. I
option
don't buy them
trade.
together. I buy them separately. Sometimes you can buy them together, but I don't.
No.
That's too complicated for me.
Yes,
I have
absolutely.
no idea what's going on there.
I remember those years. That was rough. That was tough.
Yeah, it
It
complicates
still pains
when
me to
you're.
think about it, to be honest.
Just stop. Anyway, so it would have cost you $1, and if you would have left this alone all day, because the market kept going up today, well, by right before noontime, it was worth $2.20.
Right. So if you'd gotten out there, you would have covered your losses.
You would have covered your losses from the put,
Mm-hmm.
and you would also made money from the call.
Yes.
For sure.
Mm-hmm.
By the end of the day,
you would have had a tiny panic attack at 12:20, 12:10. That would have been annoying. Oh, you lost your opportunity by 2:15. You're sure you're going to lose it all.
Both by 2:15, your put and your call are both losing your money at this time.
Yes.
However, let's just say, well, if the market's really going down, my put might come back up, but just keep it. I mean, what's going to happen? I mean, you're so if you would have been patient and either were smart and sold it at the $2.20
right
at noon.
So that would have been the safest, most conservative move, is to sell it right there at 11:30 in the morning when you made your $100. You covered your $100 loss.
You covered your $100. Yeah, at noon it wasn't even down. It was 50 cents by noontime. The put option. So you would have definitely at noontime.
You'd have been doing good.
Right before
and
noon,
you'd been able to go on with your day.
You could have sold your put at 50 cents. You would have sold your call at $2.20, and you would have came out $120. Right? Is that
and
right?
you would have still had 4 hours left of your day, which I really like. I think you're spending all day watching this.
220,
really takes 220, a lot of the
take away 50. So that's $150 you would have made, somewhere around there. But if you would have kept it to the end of the day, you would also, if you would have sold it right before 4:00, you could have sold it at 260. Your put is worthless at 1 cent, and your call is, because the market went up all day, luckily for you, because you didn't sell at noon.
That's a hard sell. I mean, you really have to have a lot of high risk propensity for high risk to sit and wait it out for that long at the end of the day.
True. Yeah. Yeah. Unless you're watching the market and you're saying, okay, well, it hit that trend line, but it didn't break that trend line, so it's going to keep going up.
Yeah.
So yeah, I mean, either way, it would have made you either you sold it earlier right before noon, or you made it at the end of the day. But either way, this pairs trade today would have made you money. And
I think the point, more importantly, is that it would have made you money at 11:30 in the morning. That's really what it's about. If you have to stick it out, sweat it out to make your pairs trade profitable just under the wire before 4, I don't think that's evidence of a really great transaction. It's the fact that it did have a lot of movement throughout the day, and that cashing out at 11:30, it met all the milestones of a profitable trade within like 2 hours of the market opening. That's it. That's a lot of activity, and it works in your favor when it's that active.
Yes, when the market is this fluid, this volatile, especially when the market is this volatile, and you're working with a VIX of 57, 60, area, it's going to be volatile. So, the options are priced into that. So for sure, they move in value. If the market moves, they move in value. And because every day is almost a 10 points difference between the bottom and the high, you're gonna, something's gonna happen there. So you're gonna make money. Only way you lose money on that pairs trade is if it went sideways all day long, and then those two would have been losing value all day long.
But if there had been like a national news announcement that something was wrong and it would have tanked, you would have made your money on the put instead of the call end, and you still would have made out. It would have
Right.
flipped the direction, but you still would have made money on this trade.
Right. And you could see at noontime, right before noon, I mean, it was that $2.20 that you could have made on your call, and your 50-cent put sold that, really
that opportunity was there for a while.
That opportunity was there for a while, but because it traded sideways for so long, your call option started losing more money and more money, because it wasn't getting up to its 260. It wasn't staying or going up past its 260 strike price. It kept after it keeps coming down, it keeps losing value. So unless it stays in the money, then it keeps its value for the most part. But all day you would have been sweating it here.
Mm-hmm.
It was down to $1 here, but if you would have been patient, it would have came out. So anyway,
right,
so that is a pairs trading. That
big takeaway on pairs trading: don't take your eyes off the screen the minute you make that pair trade, and get out as soon as it's.
You were saying that
I just said that the summary takeaway off of the pairs trading strategy is that stay attentive in the beginning. As soon as you make that buy on that pair trade, don't walk away from it, and as soon as it gets in the money where you're making money on that trade, get out of it. Don't wait for the Hail Mary. You might get it at the end of the day, and that's great. That's like insulation.
Right,
but if you don't take that first opportunity, it's a nightmare of a long afternoon wasting time to make $150.
Yeah, don't get greedy. Take advantage of your profits. Don't let your winning trade turn into a losing trade. Make your money. I mean, if it's there, take it. And fear of missing out on more money is kind of a worse deal than losing it all. And
the market is not your friend. You can't see the future, and and if you've got a lot of volatility and those options look like a good idea, get in and get out.
Yeah. All right. Well, that's all the time we have now. Thank you, honey, for doing this video with me. And
you're welcome.
Appreciate you always being here. Anyway, have a good night.
Good night.